The collapse of China's #1 real estate company, Evergrande, has sparked fear that the world might enter another period of uncertainty similar to what we saw with the start of the pandemic in 2020. We're once again reminded that the global economy is tightly knit and that a crisis in one country can potentially bear devastating effects on all other nations. When markets collapsed last time, investors noticed that cryptocurrencies had closely followed the stock market. For example, Bitcoin tended to mirror US indexes like the S&P 500 and Dow Jones to the effect of producing charts that look almost the same right to the pip. If stocks were green in North American time zones, Bitcoin would be green as well. And if stocks were to massively fall right before the bell ring during Asian time zones, Bitcoin would surely take a punch as well. If investors have to face the same trading environment again, it's more than warranted to be fearful of the current situation. Hello and welcome to Shrimpy, the #1 crypto education channel here on YouTube. In today's video, we'll take the time to review the relation between decentralized and traditional investments to find if Evergrande or any other uncertain factor can make Bitcoin correlated to the stock market again. As we all know, crypto markets haven't been doing great lately. The Federal Reserve talks about raising the debt ceiling, a company in China stirs fear of an imminent disaster, and SEC Chairman Gary Gensler is ramping up his efforts on regulating digital assets. As all of this occurs, investors are becoming more panicky than usual, which in return leads to more volatile market movements. But one not so new trend that became painfully obvious to everyone is correlation. Correlation is a complicated topic, and Bitcoin's status as digital gold is even more so. If you believe that you're lagging behind on this crucial area of crypto economics, feel free to check out the Shrimpy Academy and read one of our many articles that touch upon this question. And remember, the Shrimpy Academy is completely free, so if you want to support us, make sure to subscribe and like this video. But enough about that. Let's get back to today's main question. Many view Bitcoin as a safe haven asset that lives in its own bubble, far away from the clutches of banks and hedge fund managers. But as the world we live in grew more chaotic, we had the chance to discover that Bitcoin's independence could be nothing further from the truth. The most popular crypto asset had demonstrated its correlation to global stock indexes on numerous occasions for the past few years and has reached a peak in 2020 when the pandemic broke out. If you don't believe it, we have the data to back up our claims. Last year, US financial services company Morningstar conducted an analysis to set the record straight and showcase how correlated different markets are. Their statistics have shown that Bitcoin retained a low correlation to traditional asset classes throughout most of its history, which made it an attractive option to investors looking to diversify their portfolios. However, the influence of other markets on Bitcoin drastically changed in 2020. Up until 2019, cryptocurrencies had a statistically insignificant correlation with other asset classes, going as far as to form an inverse correlation in years like 2013 and 2018. But in 2020, Bitcoin's correlation rates hit a record high with the S&P 500, gold, and oil. As you can see on the graph here, Bitcoin's ups and downs resembled SPX's very own market performance right after a devastating crash in March. Up until then, the so-called digital gold would behave in an isolated fashion, following TradFi on special occasions only. Bitcoin's loyalty to TradFi remained particularly strong in the period between March and June. For a short time in July, cryptocurrencies had a mind of their own. But as investors sold their stocks in anticipation of the October effect, things have returned to normal. In the midst of September, Bitcoin had crashed in rhythm with the stock market, and both markets would continue to rise up and down right until December. In 2021, Bitcoin has slowly but surely decoupled from the stock market. But as trouble brews in China, we are now back on track to forming a particularly strong correlation again. Being the #1 real estate company in the second most powerful economy in the world, Evergrande is short of being an isolated anomaly. The company has lost 90% of its valuation over the course of 6 months, and with debt piling on, the real estate giant is incapable of staying afloat without defaulting. With as much as $300 billion in liabilities, some dare to compare Evergrande's dire situation to the Lehman moment. But the possibility of 2008 happening again is a topic of its own. For the scope of today's video, we will limit ourselves to discussing correlation and correlation only. When the S&P 500 dropped by up to 2.5% this Monday, Bitcoin had a 15% crash that turned investor expectations upside down and turned the mood bearish. As stocks momentarily rise, Bitcoin now recovers its recent losses in rhythm with traditional finance. Not only is this a sign that a trend is being formed, but it also goes to show that investors cannot rely on technical analysis alone anymore. No one was ever hurt having an edge in crypto markets by keeping track of the latest news with platforms like crypto Twitter or even the Bloomberg terminal. But these days, it almost seems as if everyone needs to keep their eyes glued to the screen to stay profitable. Like anything else in life, managing your investments based on news articles has both benefits and drawbacks. But in general, a strong reliance on news keeps the need for technical analysis at bay, making the already competitive market even more difficult to deal with. For example, expert traders who have a knack for programming can build bots and engage in algorithmic trading to mirror indexes. If the S&P 500 moves up 100% of the time, so will Bitcoin. So why not automate your trades when the strategy clearly works? Such a trading environment also rewards those who are willing to put more hours into the market. Even newbies outperform traders with years of experience simply by being the first ones to hear breaking news. Refreshing a journalist's Twitter feed all day is not the most entertaining thing to do, but it can make the difference between surviving a sudden flash crash or not. This week, news of a cryptocurrency ban has surfaced from China for possibly the 100th time. The People's Bank of China, which is the nation's central bank, announced that it had banned all users from engaging in all kinds of cryptocurrency transactions, be they from mining, trading, investing, or payments. The bearish news had negatively affected the market, forcing Bitcoin to suffer a 9% loss from its recent highs. Those who were stuck on technical analysis had no way of predicting that the dump would happen and have thus faced liquidations as a consequence. So as we can see, global uncertainty has reignited a new era of cryptocurrency investing. Market data is still an important aspect for traders, but for the time being, it's not enough to prevent losses. Those with underwater positions will have to adapt to the new shift and change their strategies. And the only way to do that is by keeping track of potential black swan events like Evergrande and crypto's very own regulatory circumstances. Whew, that's a lot of information to process. Let's take a quick break and test your understanding of crypto economics by popping in a question or two. Let's start with the easiest question. What is Evergrande exactly? Evergrande is China's #1 real estate company. Here's the second question. Was Bitcoin correlated to TradFi markets for a majority of its history? Bitcoin has had a statistically insignificant correlation rate for most of its lifetime. And here's the last question. Has Bitcoin briefly started another correlation trend in September? Yes, Bitcoin is correlated again now that the Evergrande drama is here. Did you answer all of these questions correctly? Congratulations, you're now ready to engage in all kinds of discussions related to Evergrande and its downfall on crypto Twitter. But there are still a few important factors that you have to learn, so keep watching until the end. In light of recent events, we can tell that Goldman Sachs commodities boss was right by saying that Bitcoin resembles digital copper more than digital gold. In an interview with CNBC, Jeff Curry, who is the global head of commodities research at Goldman Sachs, has commented on Bitcoin's status as a safe haven asset, stating that it is a risk-on asset contrary to popular belief. To quote, "Digital currencies are not substitutes for gold. If anything, they would be a substitute for copper. They are pro-risk, risk-on assets. They are a substitute for risk-on inflation hedges, not risk-off inflation hedges. The comment came at a time when Bitcoin suffered a 37% fall from $57,000 down to $36,000, which, as we all know, was followed by another crash down to $28,000. Being so susceptible to volatility, it is more than obvious that it is still early for Bitcoin to compete or even replace gold as the #1 safe haven asset. So to answer the main question of this video, yes, Evergrande is indeed bringing correlation back to the table along with other uncertain global factors such as inflation and regulation. Taking into account the latest price action, it is safe to say that Evergrande has already made Bitcoin correlated to the stock market and that we are far too deep to return back to normal. In fact, Bitcoin will retain a high level of correlation for as long as psychology matters in markets. We might see slight deviations from time to time, but with investors panicking every time they read a bearish news article, it'll take months before traders go back to the fundamentals and earn back the ability to trade by analyzing, rather than reading news. That's it for today's video. If you enjoyed watching it, make sure to leave a like and subscribe to our Shrimpy YouTube channel. And if you have reasons to believe that correlation is just a meme, feel free to leave your thoughts in the comments below. Until next time, thank you so much for watching.